Should you buy or build a business in 2023? Now, I think the real question we're asking here is, should you buy a business during an economic recession or downturn? And while a lot of people are hesitant to make purchases, or there's just a lot of uncertainty around what to do with your capital at this time, there's a lot of advantages that a lot of business owners are taking advantage of right now. So this is not meant to be financial advice or telling you what to do with your money, but this is just a way to give you awareness about what is happening in the online M&A space right now, so that you can then make your decision about what might be best for you. So right now there's a lot of uncertainty around what is going to happen in the economy. There are very public layoffs happening, and so this is a very real thing, and I think the natural inclination is to hold on to your money or to just wait and see. Now, I have absolutely nothing against doing that, but I think if you were on the fence or wondering what you should do with your money at this time, then here are a few reasons why now could be an excellent time to buy in 2023, especially during a downturn. Now, the first is that you're buying businesses at lower valuation prices. So the way that Empire Flippers values online businesses, or a part of that calculation, comes in the average monthly net profit of a business. So some businesses might be seeing a lower monthly revenue as a result of an economic downturn, and this just serves to decrease that average. Even if nothing about the business itself, the business fundamentals haven't actually changed, so you could potentially get a better deal on a business purely because of that. Now, of course, you'll want to perform your due diligence on this business to determine if the business is experiencing a temporary decline and you feel like it's going to bounce back once the economy stabilizes, or just maybe customer sentiment stabilizes. And what happens with declining prices is some sellers who want to sell their business more quickly might be more flexible during the negotiation itself. So pairing that along with a decreased sales price might set you up for a really great deal during this time. Next is the increased availability of businesses for sales. So even just a year ago, we had businesses on the marketplace that were snapped up within just a matter of hours even. And these were 7-figure businesses even. And this kind of feels similar to when houses were being bought, sight unseen, cash up front, over 100% of the asking price. So with businesses selling at a slower volume, this allows you time for that due diligence, to take a little bit more time and to comb through listings and to really try to find that hidden gem business that would be perfect for you. Now, of course, not all businesses are perfect, and this is actually something that you want, because those imperfections are the growth opportunities for a business. So you want to look for a business that is profitable despite its imperfections, that you then feel like you'll be able to increase the valuation of by filling in those gaps. And that's the third point, is that there's potential for more significant growth. So if you kind of think of this similar to a stock, think of a stock where the company's fundamentals have not changed, but the price of the stock is just reflecting the overall sentiment of the market, so the price of the stock has dipped. So let's say you want to grow the business by 20% to make an acquisition worth it for you. You might be able to hit that target just by leveraging time and by purchasing when the revenue is lower, just by even sitting on the business, not even implementing other growth tactics, just allowing the revenue to bounce back. Now, this strategy isn't for everyone. It can be seen as risky, but as a couple ways of reducing your risk, I would first recommend considering buying businesses in evergreen markets. So businesses where the products will continue to be relevant not only across the entire year, but also continue to be relevant to people or needed by customers even during an economic downturn. And the second way is to consider ways you can reduce the amount of personal capital that you're using to acquire a business. Now, this can be in the form of negotiating an earnout with a seller. If you find a great business for you and the seller thinks you would be a great buyer, there may be flexibility in terms of them working with you for an earnout, which is pretty much where you're not paying 100% of the cash up front for the business, and you're paying out either the rest of the sales price over time, or maybe even a percentage of the revenue or net profit of the business. And another option is to get funding for a part of the business. We actually work with a company called Bupos, and they offer online business owners funding for acquiring online businesses, and they don't require a personal guarantee. So this just reduces your personal liability if you were to go that route. Now, if you're new to the online business acquisition space, a quick summary, why would you want to buy a business over building one? Well, the main reason is that you have everything built for you. You have established infrastructure, so all of your business operations are put together. You have an established customer base, so you have achieved product market fit, you know who your audience is to the point where you can find more of those same kinds of customers. You know how you'll be able to potentially continue selling your product to your existing customers. And you also, if you're in e-commerce, you also have established vendors and suppliers. So that's a huge deal in the space of e-commerce, where part of the unique selling proposition of an e-commerce business is the relationship to your manufacturers in terms of being able to produce high quality products, higher quality products than your competitors, or to maybe even work on an exclusive relationship with a manufacturer to create products that other manufacturers are just not creating for your competitors. And of course, if you're buying a business through Empire Flippers, you'll have immediate cash flow coming in. And this is important because when you're deciding if it's better to buy or build a business, I think the assumption is that building a business is absolutely going to be the cheaper option for you, which it could because you're putting in your own time. But also think about the fact that when you're buying a business, you are beginning to immediately generate that cash flow, that income. Meanwhile, if you're building a business, that's time spent where you're not generating any cash. You might even be spending cash to hire other people. So it could eventually actually become more expensive for you as a business builder, depending on the timeline, the expense, the risk of the business that you're trying to get into. Now, I say all of this to say that in both cases, there is, of course, a degree of risk, whether or not you buy or build a business. And this is not meant to turn you off of either path, but this is meant to just help you evaluate and calculate or measure the risks for what they are of building or buying, and then making the decision from that point about what would actually be best for you. So if this is a path that interests you, I'll leave a video here from Greg, our director of marketing, about the first step about how to buy an online business and succeed. So that's all for now. Thanks for watching. See you in the next one.